Hello, welcome to a practical guide to financial wellness. Small steps can make a big difference in achieving your goals. My name is Kelsey Arvai, and I'm a certified financial planner at a boutique firm in Southfield with a satellite location in Brighton called the Center for Financial Planning. I'm part of a 30-member team, 15 of which are certified financial planner professionals. Personally, I've been in the financial services industry for 4 years now. You'll see some of my team members there on the left side of the slide there. Today, we're going to explore the concept of financial wellness, why it's essential, and how you can apply its principles to your own life. If you have questions, we want to be respectful of everyone's time. So please feel free to keep track of those and email me, and I'd be happy to answer those at the end. So let's go ahead and get started. What's financial wellness? I think of financial wellness as financial self-care. At its core, financial wellness is the state of well-being related to your finances. It's the state you achieve when you know what you have and where you're headed, and you feel confident about it. It's adaptable and it's attainable for everyone, regardless of your financial situation. Financial wellness is adaptable and attainable for everyone, regardless of your financial situation. Financial wellness is crucial because it provides you confidence and peace of mind. It improves your overall well-being and your quality of life, and it helps to counteract financial stress. So financial wellness is comprised of three key components. Let's delve into each one of these. First, we have your foundation. So this is where you can take control of your finances. We have your mindset. So this is where you make progress towards your goals. You understand where you've come from and where you want to go. And then you have your financial plan. This is where you are preparing for the unexpected. So your financial foundation is like the sturdy ground upon which you build your financial future. It consists of some core building blocks. These are familiarizing yourself with where your money goes. So the way that you spend your money or the way that you live your life is unique to you. So that's why it's up to you to learn how your money moves both in and out of your accounts. You always want to take advantage of free retirement money. Your employer typically will have a 401k matching program. And if they do, you definitely want to sign up and grab that free money while you can. I'll get into that a little bit later about why that is so important. You want to have at least 1 month's take-home pay saved. Life is full of unexpected costs and life changes. It's important to have 1 month's take-home pay saved for emergencies. You also want to zero in on your high interest debt. So by eliminating this type of debt, you can help gain more financial security. Most credit cards and even some personal loans come with super high interest rates. Anything more than 10% is considered super high. So getting rid of this debt ASAP is crucial. Once you've had 1 month's take-home pay saved, you've gotten rid of all your high interest debt, you want to finish funding your emergency savings account. And that is anywhere from 3 to 6 months take-home pay is typically what we recommend. 3 months is when you are living alone, no one is dependent on your income. 6 months is a lot more conservative if you have someone who's dependent on your income or children, or you have a lot of expenses. 6 months is much more conservative to have saved as your emergency fund. And then once you have these elements completed, you want to move on to your medium interest debt. This maybe your debt from 5 to 10%, it could be your mortgage. And then you want to have a strategy to pay this down over time. And then we're always thinking about what your goals are, your financial goals, and how we can achieve them. So we want to make sure that you're investing every day towards your goals and getting on track for financial independence. The next critical component of financial wellness is your mindset. It's all about fostering a healthy relationship with your money and your ability to manage it. And there's different ways that you can work on that. You first want to identify and unlearn harmful myths about money. It can help to start with your past and understanding how adults in your life dealt with money. And then once you have a good understanding of what brought you to today, it's important to think about your current money mindset and the factors that govern how you spend your money in this moment. Getting comfortable talking about discussing money with others is very important. There's a lot of data that supports the idea that talking about money makes your relationship with money and with the people around you in your life better. And then lastly, you want to give yourself permission to use money in a way that makes you feel good. So whether that's finding ways to reward yourself, if you are trying to limit your spending in some way, or if it's donating to a charity that you really enjoy, giving yourself permission to do that is really important, especially when you're putting in a lot of hard work to put yourself in a really good financial situation. So, what is financial planning? Financial planning is how you get what you want out of life. Money is just the fuel for our journey. You want to think about what are your life goals? What are the financial steps that you need to reach your goals? You want to make a plan and then you want to stick to it. You want to implement it and stick to it. Financial planning is a lifelong process and journey. Your financial plan is the strategy and the steps to follow to help you and your money get you where you want to go in life. It's made up of the tools and the timeline, all designed by you that help you hit your goals. So here are some things that help you form your plan. You want to identify your core values, create a budget that works for you, and you want to prioritize your various financial goals from short term to long term. Through understanding our money mindset, we can truly understand what our core values are. And that's a really important place to start. And once we have that understanding, we can move into more of the budget side of things. So, how do you find your preferred budgeting style? Budgeting systems are designed to help you understand and evaluate your relationship with money. And they all share a common goal, and there's a lot of options there for you. You first want to think about the 28-36 rule. So your housing expenses shouldn't exceed 28% of your gross monthly income, and your total debt payments shouldn't exceed 36% of your gross monthly income. With that, there's two different ways to think about the different budgeting systems. Do you like tracking your expenses? And then do you have a priority of putting money aside or increasing your savings rate? Looking at a rule of thumb, such as the 50-30-20 rule, which means 50% goes to necessities, 30% goes to your wants. So that's the things that you don't need, but you enjoy doing, like going to the movies, having dinner with friends, traveling. And then 20% should be going to savings and debt repayment. And you can use this rule of thumb by itself or as a baseline for other flexible budgeting methods. On the opposite end of that, so if you don't like tracking your expenses and you want to start putting money aside, you can use the envelope system to help categorize your expenses. The envelope system is a very rigid system to help you stop spending money frivolously or stay out of debt. Um, but you don't want to track every single one of your purchases. You can try this approach using cash. If you still don't want to track your expenses, but you want to increase your savings rate, you really want to use the pay yourself first method. This is designed to align your spending and values. And it's kind of a reverse budget that puts savings before immediate expenses. So with this system, you decide how much you set aside for your monthly income, for savings goals like retirement and emergency fund, and then you use the rest for bills and other costs. That way you don't have to crunch every single number. And then lastly, we have the zero-based budgeting method where you enjoy tracking your expenses and you want to put money aside. So this budget suits overspenders and meticulous planners. It makes monitoring your spending clear. You take your monthly income and you use every dollar in a very deliberate way, like saving for a certain trip or paying for utilities and groceries until there are $0 left. So there's a lot of options of how you can think about what would work the best for you and what fits your natural lifestyle and go from there. So once we have our budgeting set, the rest of the building blocks kind of fall into place. A lot of people believe that having no debt is ideal, but in many situations, debt can actually be considered good for your finances if it helps you build wealth. For example, if you cannot afford to buy a home with cash, you may have to go into debt with a mortgage, and that in turn can help you use your housing payments to build a real estate asset instead of renting. With education, it's generally for education in general, the more education you have, the greater your earning potential. Education also has a positive correlation with the ability to find employment. And advanced degrees can often pay for themselves. However, not all degrees are equal in value, so it's worth considering the short and long-term prospects for any field that appeals to you. And lastly, a business may be an appropriate use of debt. Like paying for education, starting your own business does come with its risks. Many ventures fails, but if yours succeeds, then the debt would be worth it. It's important to weigh the risks of the debt you take on and consider if it will help you generate income or help to build your net worth. Taxes. This is everyone's favorite subject. Having a good tax strategy can reduce your tax liability and related anxieties. Um, it's important to consider working with a financial advisor, someone who can help explain deductions, qualified credits, and tax advantaged accounts, and what's most beneficial for you in your particular situation. The more money you make, the more you pay in taxes. This is, generally an understood notion. When you are enrolling in a job, your employer must file a Form W-2 for each employee, where income, Social Security, and Medicare taxes are withheld. Income tax would then be withheld if you choose to claim no more than one withholding allowance. And this is where you also want to consider making the most out of tax advantaged retirement and health savings accounts. Funding those pre-tax accounts will help to lower your taxable income, and that depends also on your personal situation. TurboTax can be really helpful when you have a really simple return. It's inexpensive, it's quick, and it's simple. You might want to consider hiring a professional if your tax situation is complicated. And the fees for that typically depend on how complex your needs are and the type of professional that you choose. Student loan interest is also important to think about. if you have student loans or you pay education costs for yourself, you may be eligible to claim education deductions and credits on your tax return, such as low interest deductions, 529 plans, which are qualified tuition programs, and Coverdell education savings accounts. And this is typically subject to certain income phase outs and limitations, but it still may be deductible, depending on, regardless of whether you are itemizing your deductions or you're choosing the standard deduction. The power of starting early and often and investing what you save are some of the keys to a successful retirement, financial independence, and this is all due to the power of compounding over the long term. This illustrates the idea that saving early and consistently can benefit you in the long term through compound interest, which means that your interest makes interest. And in this scenario, this assumes that each individual is saving $200 a month for a period of time. There is a 6.5% annual return, and cash assumes 2.25 annual return. We have consistent Chloe, who invest from ages 25 to 65, earning 6.5%. She saves $400,000 total, and at retirement, her ending portfolio balance is 1.8 million. Quincy he starts at 25 and saves until 35, saving $100,000 total, earning 6.5%, and his portfolio balance at retirement is just under $1 million. We have Noah, who saves from 25 to 65, the same as Chloe, but keeps the investment in cash, saves $400,000 at 2.25%, and the ending value is about $650,000, which you can see not investing in the market. There's much more growth potential with Chloe's portfolio than there is with Noah's. And then Lila, she starts 10 years later than these other individuals at 35 and saves until 65 at 6.5% assumed annual return, average annual return, and she saves $300,000 total, and her portfolio value is about $919,000. So this really shows how important it is to save early and often. So this next slide illustrates how increasing our monthly investment contributions can dramatically affect your household in the long term. So with a $10,000 starting balance, with no further contributions, assuming a rate of return of 6%, we see an ending balance of about $57,000. The second example shows a $10,000 starting balance and $500 of monthly contributions, and we see after 30 years the portfolio is worth about $500,000. And when we have that $10,000 starting balance, $500 of initial monthly contributions plus a 5% annual increase in contributions, we see that this portfolio has grown to $933,000 after 30 years. So the earlier you start investing consistently, the more you will harvest the reward of compounding interest. And this assumes an annual rate of return of 6%. Let's talk about retirement savings. So we have employer plans and we have Roth and traditional IRAs. Typically with employer plans, we see a 401k, 403b, SEP or simple IRAs. This is we would recommend that you contribute at least the match and increase your savings rate by 1% each year. You do want to consider your investment allocation. Depending on your circumstances, a target date fund is a good idea or could be a good idea. You'll want to select the year that you hope to retire. When you're deciding between a Roth IRA and a traditional IRA, a Roth IRA makes a lot of sense when your income is very low. So you want to use that after-tax money now and make tax-free withdrawals at retirement. With a traditional IRA, if you don't have access to an employer plan, you get a tax deduction now, but you'll pay taxes on withdrawals at retirement. And then some employers offer a Roth 401k, where that's similar to a Roth IRA as part of the employer plan, and it functions the same as the Roth IRA for taxation purposes. This next slide illustrates the importance of utilizing the full employer match. In this example, we assume annual returns of 6% that compound monthly for an investor who's making $80,000 a year. That goes up 3% each year, and the employer fully matches up to 6% of the salary each year. And you can see the employee contributes 2%, 4%, and 6%. And each of the ending portfolio balances after 30 years. By not utilizing the full match, you could be leaving more than $500,000 on the table. If the employee contributes only 2%, the ending portfolio balance is $363,000. If you contribute 4%, you have $726,000. And if you utilize the full match of 6%, the ending portfolio balance after 30 years is about $1 million. So there's a lot of tools regarding risk management. You want to evaluate your insurance needs, your coverage, and your costs. You want to consider at least having health insurance, life insurance, disability insurance, motor vehicle insurance, and home insurance, or renters if you rent. The different types of insurance to consider, the ones I just listed, most of those fall under personal, while some of them fall under property. You really want to consider what stage of life you're in. If you're younger and you don't have as many assets, or you're just starting to build your net worth, not as much insurance is needed. If you have a family, you have a home, you want to consider more insurance that's typically needed in this situation. And then you want to make sure that you have the right insurance products. So coverage might be inadequate or excessive. You really want to look at the fees, the deductibles, the copays. And we'd always be happy to recommend professionals that specialize in an overall risk review to help you create a plan by reviewing your current policies for potential improvement in overall asset protection, as we work together with them to make sure that your financial plan is solid. Estate planning. It's really important to make sure that your legal documents are in order to ensure that your wishes are realized. You want to establish your wills. You want to make sure you've named beneficiaries on all of your accounts. So your work plan, you can add payable on death to your checking account or bank accounts, and you want to designate a power of attorney. There's different types of power of attorneys. General power of attorney has the authority over all the decisions allowed by law. So, for example, living decisions such as hiring caregivers or choosing a residence. You have a financial power of attorney. This person would have power over bill pay, banking, retirement benefits, tax filing, all of your financials. And then you also have a medical power of attorney. This person would have authority over your treatments, your surgery, your end of life care, So it's really important to take a look at uh, who you might want these people to be and how you want um, your life to be taken care of. And it might not be the same person for all of these different things. We do have some disclosures if you want to take a moment to read over those. Getting started with your financial wellness journey may require effort, but it's worthwhile. Remember, the challenges are common and the financial industry can be confusing. So, getting started by using resources like the center, where we have tools and webinars and guidance where we can help you. We love to help you start building your financial foundation. So thank you for taking the time today. I hope you found this presentation valuable. If you have any more questions, feel free to reach out to me. My email is kelsey.arvai@centerfinplan.com. Thank you and have a great day.